Good morning. And today we are going to take up trading account. Trading account. And this is one of the components of final accounts. You have trading account, profit and loss account, and balance sheet. All these three put together are called as final accounts or financial accounting. Okay, we call them as final accounts. The first step to final account is trading account. Okay, now this trading account or profit and loss account or balance sheet, they are prepared at the end of the accounting period. Now, what for do you prepare? It is to ascertain the profit or loss, the result of business operations. Before you ascertain the profit or loss, you have to ascertain the gross profit. Okay, what is this gross profit? This is the difference between the selling price and the cost of goods sold. For a trading firm, what is the job of the trading firm? It purchases the goods and sells the goods. That's all. It does not make any product. Okay, and the difference between the purchase price and the selling price is what profit for the trading firm. Now, the cost of goods sold are deducted from the sales, thereby you get your gross profit. From this gross profit, you deduct, okay, you remove all your administrative, selling, and distribution expenses, you will get your net profit. Now, what are the items that we have to take into consideration while preparing trading account? Trading account. Now, look at this. We have, so many items. I'll just list out one by one. Before that, I have been talking to you that, at the time of fixed assets and the depreciation on the fixed assets, when you're purchasing machinery, an asset, till it is brought and put into use, that is till it's commissioned, what all the expenses that you incur, the transportation, the tax you pay to bring that asset, okay, the installation expenses, the service charges that you pay to the engineers, installation engineers, all that are included into the value of the asset, the cost of the asset. Then you will say this is the cost of the machine. Let's say you bought a machine for 2 lakhs and you have paid transportation 10,000, 2 lakhs, 10,000, taxes, various taxes while it is coming, you have paid all put together, that's 5,000. Another 5,000 you pay to the service engineer. Okay, so 20,000 all put together is 20,000. Now 2 lakhs is the cost and 20,000 are the incidental expenses for the machinery. Now, when you are accounting, you have to account for 2 lakhs 20,000. When somebody asks you, or when you're recording in the books of accounts, what is that you do? You record 2 lakhs 20,000, not 2 lakhs. Okay, 2 lakhs 20,000 you will be recording. Fine. Now, similarly, when you're purchasing the materials, you have to include all the incidental expenses while you're purchasing the material. That is transportation or cartage or the octroi, whatever you incur till you bring that to your go down, all should be included. Okay, all should be added to the cost of the material you're purchasing. Then you will get the total cost of the material or goods. Okay, now we will look into the details of those things. Okay, those items. Number one is opening inventory. Okay, when you are a trader, you keep buying and selling. Now, what was closing balance? Closing balance of the goods last year will become opening balance, opening stock. That's called opening stock, opening inventory. Inventory. Now, if it is a trading organization, there's only one item, one type of item, that is finished goods, inventory or stock. But If it is a manufacturing organization, this inventory or stock are divided into three: raw material, number one; work in progress, number two; and finished stock, number three. So these three are the forms of the inventory, the types of inventory, the types of the stock. And this stock can be opening and can be closing. What was closing last accounting period, during last accounting period, will become opening for this accounting period. So therefore, the entry is trading account debit to opening stock. Okay, trading account debit to opening stock. The next item is purchases and purchases returns. Now, when you buy the materials, and this is an expense, okay, purchases are expenses, and all purchases are debited to the profit and loss account. What is profit and loss account? I told you, or trading account for that matter, they are nominal accounts. All expenses are debited and all incomes are credited. And in this case, purchases is an expense. If it is an expense, it is to be debited to the trading account, Now, if there are purchase returns, you can deduct these purchase returns from the purchases, then you will get net purchases, net purchase. Okay, what's the entry? Trading account debit to purchases account. This is the entry for purchases. Okay, now, for example, if yeah, I'll discuss this in the next point. Okay, the next one is carriage of freight. And same thing, what treatment you give to purchases, the same treatment is given to all the expenses that you incur, like carriage, octroi, taxes, excise duties, cantonment charges. All that cantonment charges means, yeah, when you're passing through the cantonment boards, Secunderabad cantonment board is there. When you're passing through that board, the roads are not government roads. Those roads belong to the cantonment. So what they do is they charge for the road that you're using. Okay, if your truck has to pass through that cantonment board, you will pay cantonment charge. Okay, so all such things should be included, okay, in the freight or carriage inward. Okay, trading account debit to carriage. And similarly, you may be hiring laborers to load the materials and unload the materials. Those things also are charged against the trading account debit to wages. And when it comes to sales are income, sales are credited into the trading account, right? Now I'll talk about returns. There are purchases and purchases returns, sales and sales returns. When it is a trading account, let's say this is a trading account. Let's say this is a trading account. Yeah, this is a trading account. When it is a trading account, look at this. Yeah, all purchases are debited. Trading account, okay, debit to purchases, right? Now, when it is sales are credited in trading account. Sales are credited in trading account. Now, when it is purchases, you're debiting, right? Then what about purchase returns? When you purchase goods come in, okay, and you're treating it as an expense and you're debiting to trading account. When it is to be sent back, when you're returning, either you credit to the trading account or simply you can take less, okay, less purchase returns account, right? So let's say purchase, or let's say 10,000 or 10,000, then purchase returns are 1,000. Okay, The net is okay, 9,000. That's it. This is how you have to write. Okay, either you take here 1,000, okay, as purchase returns, okay, and take 10,000 here. Okay, take 10,000 here. Let's say I'm not taking this. Either you take purchases 10,000, okay, purchases 10,000 and purchase returns 1,000 on the credit side. Or you can do this way also. Okay, two purchases 10,000 less purchase returns 1,000. Okay, this purchase returns is negative. Then the resulting figure is 9,000 you're taking on the amount column. And this will not be there if this is the treatment you're giving. Right? Now, similarly, when you have sales of, let's say, 200,000, okay, 2 lakhs, right? Either you can do it like this, less sales returns, okay, of 20,000, okay, then you will get 1,80,000, 1,80,000, right? So this is how you can do. Or you can also say 20,000 as returns here. You can do this way also, 20,000. Yeah, 20,000 you can write here, okay, without writing anything here. Look at this. Sales are credited, sales returns are debited. You can do this way or you can do this way. Okay, sales less sales returns, and this will not be there. Right? Do you understand? Purchases minus purchase returns, sales minus sales returns. Right? This is all about purchases and sales. And the next item is closing inventory. Closing inventory is generally credited. Okay, closing inventory is generally credited. And
Sir,
yes, please.
what can I ask?
Yeah. And look at this. There is one more thing. Students may note that in case of closing stock is not mentioned in the trial balance, then it means opening stock and purchases appearing in the trial balance include the value of unsold stock, which means closing stock. Okay, since we prepare our financial statements using matching concept, such unsold stock should not form part of the cost and therefore deducted. Therefore, in this case, compute cost of goods sold. And how do you calculate? Opening stock plus purchases minus closing stock minus purchase returns gives you cost of goods sold. Gives you cost of goods sold. Okay, so yeah, closing entries in respect of trading account. For opening inventory, debit the trading account. For purchases, debit returns outwards and credit purchases account. Right? Then for purchase account, debit trading account. For expenses, debit trading account. Sales, credit sales account. Credit trading account. Look at this one. Sales to be credited to trading account. Okay. Expenses to be debited to trading account. Okay. Purchases to be debited to trading account. Right? Remember these three. And lastly, debit inventory account and credit trading account. What for? Closing. If it is closing, credit to trading account. Okay. If it is opening, debit. If it is opening inventory, debit to, if it is opening inventory, debit to trading account. If it is closing inventory, credit to trading account.
Sorry, miss.
Yeah. Yes. So let us sum up. Okay. Let us sum up the points to be considered, the accounts to be considered for trading account. Okay, the opening account is debited to trading account, purchases to be debited to trading account, wages to be debited to trading account, road tax, octroi, or any taxes to be debited to trading account. Okay, and then finally, freight and transportation is to be debited to trading account. What is to be credited to trading account? Sales to be credited to trading account. Okay, closing inventory to be credited to trading account. If there are returns, okay, you have to reduce the returns at that. This is more easy and it avoids confusion. Returns should be uh, deducted from that very type, right? For example, purchases to be deducted from purchase returns to be deducted from purchase returns to be deducted from purchases account, sales returns to be deducted from sales account. Okay, just like this, right? Now, the final result of the trading account is gross profit. If your credit side is more, then if your credit side is more, then it is gross profit. Okay. If credit side is less, then you call it gross profit. Okay. Gross loss. Gross loss. Debit side is more than credit side, gross loss. Credit side is more than the debit side, gross profit. Right? That's it. So this is an explanation how we can prepare trading account, but I think we should have some, yeah,
Sir,
yes.
sir, profit and loss account, sir, if the trading account is telling us profit or loss,
Gross
then
profit. Yeah, it is gross profit. It is not profit, it is gross profit.
what's the difference, sir?
Huh?
What's the difference? I'm asking.
Huh.
For profit and,
Yeah, the gross profit is the difference between sales and the cost of the goods sold, the worth of the goods sold. Whereas profit and loss account net profit is the difference between gross profit and all the administrative expenses. Selling, distribution, administrative expenses are deducted from gross profit so that you get your net profit or net loss. Okay, clear? Yeah, it will be clear only when you take up a problem. Right, can you see this? Can you see this? Can you see preparation?
not totally, sir.
Yeah.
It's open.
Yeah. Now this is the format of trading account. Okay, template of trading account or specimen of trading account. It is an account which is prepared by a merchandising concern which purchases goods and sells the same during a particular period of time. The purpose of this is to find out the gross profit or gross loss, which is an important indicator of business efficiency. The format is, on debit side, you take the opening stock, okay, opening stock of goods, okay. Then if it's a manufacturing, then you will have so many items of opening stock: materials opening stock, work in progress opening stock, finished goods opening stock. When it is trading, where you don't manufacture anything, you're simply buying and selling, then this is how it happens. Okay, this is the only item, finished goods only appear here. Then purchases, okay. From these purchases, deduct if you're returning anything back, defective or excess lot received, return back. So what you get is net purchases, right? Then on credit side, you take sales and deduct sales returns, then you get net sales and take the closing stock also. Okay, that's it. That's all the items on the right side, debit side and credit side. Debit side, all expenses, credit side, incomes. The difference between the incomes and the expenses is gross profit. This is the gross profit. The difference between the debit side and credit side, where the debit is more than the credit, then you get gross loss here. Gross loss. Gross loss. And this gross profit is transferred to profit and loss account. Okay. And similarly, gross loss also is transferred to profit and loss account on the debit side. Okay. Now let's take a problem. Following are the ledger balances presented. Ledger balances. What is this, Sabrina? This is the answer for your question. Well, now where do you get this information, sir? You ask me. What's the relevance of your trading, your ledger accounts and trial balance? Yes, these are the summary of ledger accounts means it's trial balance only. Okay. He's not calling it as trial balance, because if it's a trial balance, it should tally, right? So it is not clear whether it tallies or not. So therefore, he simply says summary of, okay, the following of the ledger balances presented. It's a summary balance of Messrs M/S. What does it mean? Messrs. What is Messrs? It's a plural form of Mr. If you are one, Mr. If you are 2-3 people coming together and starting business, then it is Messrs. Plural form of Mr. is Messrs. P. Sane, as on 31st March 2013. Right? Okay. Stock 10,000. Look at this. On the first day of the accounting period, 1st April 2012, opening stock 10,000. Okay. Then purchases 1,60,000. Carriage inward 10,000. Wages 30,000. Okay. Freight 8,000. Then sales 3 lakhs, returns outwards 16,000, returns inward 16, returns outward 10. Okay, royalty on production 6,000 and gas and fuel 2,000. Stock on 31st March, this is closing stock. Okay, the market price is 24,000, the cost price is 20,000. The rule is market price or the cost price, whichever is less. Stock valued at 10,000 were destroyed by fire, and insurance company admitted only to the extent of 6,000, and there's 4,000 loss. Okay, goods purchased for 6,000 on 29th March 2013, but still lying in transit, not at all recorded in the books. Goods taken for proprietor for personal use for 3,000. This is drawings. Outstanding wages to be, it is added to the wages. Freight was paid in advance. Okay, freight paid in advance is 1,000. Outstanding is added, advance payment is deducted. Okay, look at this. Yeah, trading account. Opening stock of materials. Opening stock of material. What is the opening stock? This is the opening stock. This is the opening stock, right? Bring it here. Trading account debit to opening stock, 10,000 in the outer column, right? Then trading account debit to purchases. How much of materials are purchased? Okay, yeah, purchases 1,60,000. Bring this 1,60,000 here. Because there are returns, okay, we will take this in the inner column, 1,60,000. Less returns, 10,000. Where do you get this 10,000 from? Where do you get this 10,000 from? Returns, purchase returns. Returns outward means you bought the material. When you bought material or coming in, when you're returning back, you're sending them out. Therefore, returns outward means purchase returns. Returns inward means you sold goods, your customers are returning them back and they're coming in. Returns inward means sales returns. Returns outward means purchases returns. This 10,000 is purchase returns and deduct this. Okay, you get net amount of 1,50,000, which is net purchase. Okay. Now, out of this 150, the proprietor has taken out 3,000 worth goods for his personal use. What is this? Less drawings. You can write here less drawings, or in this problem, goods taken by proprietor. What is that? It's drawings, withdrawal. Okay, from the business, 3,000. The net is 1,47,000. Out of this 1,47,000, some goods are not yet reaching your premises. They're not in the premises. So you have to deduct those, you have to add those things also. Sorry, you have to add those things also. There's some goods you have paid, or there's an invoice raised, whether paid or not, invoice is raised. They're on the way. You have to take those things also into consideration. Okay, 6,000. 147,000 plus 6,000 gives you 1,53,000. Okay, this is the total worth of the material. How much of adjustment you have given? Look at this. This opening, we don't have any problem with that. Purchase, when you purchase, there's a returns also deducted. You got 150. And some goods are taken by proprietor, 3,000, deduct that also. Some goods are in the transit, they're on the way to reach your warehouse, add that. So the ultimate figure of materials is 153, okay, right? And 153 plus 10, 163. Okay, this is the total worth of the materials. Then likewise, you have other expenses. All expenses are to be debited. No? Wages, 30,000. Okay, freight, 8,000. Right? Wages, 8,000. Freight, I'm sorry, wages, 30,000. Wages, 30,000. To this wages, you have 4,000 outstanding also. Whatever is outstanding is added, whatever is prepaid, deducted. Outstanding wage is added to this expense of wage, so that the total amount of wage became 34,000. Similarly, there's a freight or carriage, freight. Okay, freight, 8,000. Out of this 8,000, okay, 1,000 is already prepaid, right? This is for the next year you paid now. This is not belong, this 1,000 does not belong to this year. Deduct this. Actual freight paid for this year is 7,000 only. Then there's a carriage inward, 10,000. That is also taken. There is no adjustment. Therefore, you have taken it directly in the amount column, right? There's an adjustment here. Therefore, you have taken in the inner column, the ultimate figure of 7,000 is taken to the outer column. And there's a royalty on the production you're paying. Okay, that's 6,000. That's an expense debit. Okay, then to gas and fuel, okay, that's part of your trading account, 2,000, right? Next is buy sales, 3,000, and less sales returns. We have already seen here sales returns, 16,000. Okay, 16,000. Net is 2,84,000. Buy closing stock, 20,000. Okay, and out of this 20,000, I'm sorry, to this 20,000, there is 10,000 worth goods destroyed. Okay, so the total amount comes to 30,000. Okay, out of this 30,000, to this 30,000, 6,000 worth material is yet to come to the go down. Okay, so the total worth of the closing stock is 36,000. Out of this 36,000, 10,000 is already destroyed. Okay, but still you have to account. 20,000 is visible now, right? 10,000 is destroyed, add that also. 6,000 is yet to come, add that also. The total worth of the material closing is 36,000. So the total of credit is 3,20,000, and this is the highest amount, and you drop here also 3,20,000, and the difference is 98,000, and this is your gross profit. That's it.
Sir, I cannot understand the credit side, sir.
Tell me, what is that?
Like in closing stock, again, might be adding goods in transit, sir.
No, look at this. It is very simple. The closing stock given is, where is that closing stock? Stock on 31st, stock on 31st is, look at this. I told you, market price is 24, cost price is 20. We take cost price, whichever is low. Principle of conservatism we had to apply. Okay, anticipate all losses, don't anticipate gain. Tomorrow, if this 20 becomes 30, that's okay. But now when you compare the market price is 24, but cost price is 20. So 20 only we should take. Market may go up tomorrow. You know, this may be a gain, 4,000 may be a gain for you, but don't anticipate. If it comes, okay, but don't account for that gain. Account whatever you have paid for. Okay, now at the moment. So you have taken this stock. And in this stock, okay, to this stock is arrived after selling and also 10,000 worth goods destroyed. That means this 10,000 worth goods are added to this 20,000. 20,000 is physically visible. 10,000 are destroyed. So 20 plus 10 is the closing stock. Is that all? No. Another 6,000 stock is yet to come, right? That is also part of the closing stock, right? Closing stock means whatever is visible, whatever is destroyed, whatever is still to come to the go down, all put together is your closing stock. Okay, right? Next, any doubt?